The big question is, can you get a HELOC on an investment property? This is what lenders won't tell you. Most investors assume the answer is no, or never think to ask. The truth is more nuanced, more accessible, and more powerful than you might expect for scaling your real estate portfolio. So let's get in. The short answer is yes, but most lenders won't do it. So number one, it's a shrinking market. Fewer than 30% of major lenders actively offer HELOCs on non-owner occupied properties now. It's quietly pulled. The big banks you already know have made requirements quite prohibitive or removed the product entirely from their line. And the real question, it's not can you get one, it's where to find one, what it takes to qualify, and what to do with it. So what is an investment property HELOC? It's a revolving line of credit secured by the equity in your rental or non-owner occupied property. Think a rental property, LLC owned BRRRR exit with a DSCR on it. Think of it like a massive credit card backed by your rental property's equity. So you borrow, repay, borrow again for the next deal. And that flexibility is actually its core advantage. So let's look at the similar products on the market. A HELOC versus a home equity loan versus a cash out refi. So the structure of a HELOC is it's a revolving line. You can get HELOCs with interest only repayments only on what you're utilizing in your current deals, whereas home equity loan, it's a lump sum. So that's the main structural differences. Now let's look at the rate. So the risk of a HELOC is it's a variable rate. So you don't want to go and max them out and then wait to repay them over time, because the risk is your rates going up and down. They're more used to get in and out of deals, backup capital, down payments, funding the gap, and scaling faster. Whereas a home equity loan's fixed, and so is a cash out refi. The HELOC and home equity loan leave your first primary mortgage intact, whether that's a DSCR or an investment mortgage, whereas a cash out refi will replace the primary loan entirely. What are they best for? So HELOCs are for ongoing flexible needs to scale and expand your capacity to take on more deals. Whereas a home equity loan's decent for a one-time amount, stretching out the repayments over a long period. And a cash out refi, the main use case there is actually to lower your mortgage rate. The closing time. So digitally underwritten on the HELOCs and home equity loans, you can get them done in 2 to 4 weeks. Typically we see about 10 days. Whereas a cash out refi is more like a mortgage. It takes 30 to 45 days. The key point in 2026 is if you've locked in a 3 to 4% mortgage, a cash out refi means you're giving that rate up forever. A HELOC sits behind your first mortgage. Your rate stays, your equity gets unlocked. So why most big banks won't offer this today? The risk logic. So lenders view investment properties as higher risk. If a borrower hits financial trouble, they prioritize their primary home payments first. So lenders price in more risk or simply don't offer the product because they're taking a second position. Where do you find investment HELOCs? So from today, community banks and credit unions are the most flexible, especially with existing relationships. So go talk to your local broker. Whereas Better Mortgage is one of the few national lenders explicitly offering 50K to 750K HELOCs on investment properties right now. Trust Financial and DSCR focused lenders as well. There's also digitally underwritten online lenders that move quickly, but their terms and rates may not be quite as good. So don't assume your existing mortgage lender offers this. Call and ask directly before starting an application. So let's look at what it takes to actually get one, the exact qualification requirements. Investment property HELOCs have stricter standards than primary resident products. Here's exactly what lenders look for across 4 key dimensions. So credit score, we're actually going to be looking at 720 to 740 minimum here as opposed to 650 to 680 on a primary residence. DTI and reserves, they want them below 43 to 50% DTI. In some cases, they may let you use it for debt consolidation with a higher DTI. Equity and LTV, they're typically going to go 75% as opposed to the 80% you might see on a primary residence. And then documentations, your leases, tax returns, and appraisal. So credit score and equity requirements. The minimums, as opposed to these primary residence, as we were saying, which is like a 650 to 680, this is going to be more like a 720 to 740. So the higher requirement reflects lender risk on a non-owner occupied collateral. If you're below 720, this is your first filter, and most lenders don't bend on it. Equity and LTV. So here's the math. Primary residence up to 85 to 90% CLTV. Investment property, most lenders will cap at that 75 to 80 CLTV. So let's look at an example here of a property valued at 400K. You still owe 220 grand on the DSCR. So the max HELOC at 75 would give you 80. If they go up to 80%, they'll give you 100. You need 20 to 25% equity remaining after the HELOC is factored in. So just to reiterate here, it's the difference between 80% of your property's current market value, go and look it up on Zillow or Redfin, versus how much you still owe on the primary loan. So let's look at DTI, reserves, rental income, and appraisals. So debt to income ratio, most lenders require a DTI under 43 to 50%. Rental income can count, but only if documented via tax returns, Schedule E, and current leases. Cash reserves, so minimum 6 months of mortgage repayments on the subject property, must be liquid, cash or near cash, verifiable, not equity, not retirement funds. So, and then you've got your rental income, your DSCR. So some lenders require DSCR of a 1 or higher, bring current lease, rent rolls, and 2 years of tax returns. And then you got your appraisal. There's going to be a full appraisal required here. Some lenders require multiple, budget $500 to $700 in 2 to 4 weeks for scheduling. So here's the hidden lien problem to check before you go and apply. The number one reason investment property HELOC applications actually get denied, it's not your credit score, it's not your equity, it's the liens on the title that you don't even know exist. So let's have a look at those. Here's the types of hidden liens that could be on your property. You got ghost liens, old mortgages paid off but never formally released from county records. Happens constantly when loans are sold between services. And IRS tax liens. Federal tax debt automatically attaches to all real property you own, even from years ago. HOA liens, even small unpaid HOA dues can trigger a lien that blocks approval. Here's one that a lot of people don't know about, mechanics liens. So contractors not paid in full can actually file against the property, especially common on renovated properties. And then finally, we've got judgment liens. So civil judgments or unpaid child support attached to your real estate automatically as well. The fix is fairly simple and it's super cheap. Before you apply, run a title search through your county clerk of court records or pay a licensed title company for a full title search. They'll cost $100 to $200, a fraction of what a denied application costs in both your time and fees down the line. The time frame is going to be a few days, so do it before the application, not after. And the bottom line is many HELOC denials are completely preventable with this one step. So a $150 title search can save you weeks of wasted effort and a hard credit pull on your record. So here's check what the prime rate is online, but here's as of mid-2026. So for a primary residence HELOC, national average 7.2%. Investment HELOC is going to be higher because of that risk baked in at a 7.75 and up to a 9.5, but it's still some of the cheapest capital available to real estate investors, as a bridge loan will be 8 to 12 and unsecured personal loans run 12 to 25%. So how is your rate calculated? Say we've got the prime rate currently at around 6.75%, plus your lender margin is your rate. So the margin's set at opening and stays fixed. Only the prime rate moves. Rates are near 3-year lows following Fed cuts in late 25. So model your cash flow, assuming rates could climb 2% from your opening rate. Build the buffer in before you draw. Here's 5 real use cases for real estate investors. So from acquiring your next property to covering emergency repairs, here's how smart investors are putting investment property HELOCs to work right now. So number one, you got down payment on the next property. This could be an opportunity that comes along while you're mid-deal, and you've actually got this line available to take that opportunity as well. Number 2, renovation to increase rents and value. Number 3, bridge financing between deals. Number 4, you've obviously got your BRRRR shortfall, as your DSCR will do 75% ARV. And then finally, you got emergency reserves without touching operating capital. So it's good to have this available as you scale. The down payment on the next property. This is the first use case. So say you have a 300K in equity sitting in a rental doing nothing. You draw 75 grand of that 300 from the HELOC against an existing rental equity. You go and use that as the down payment on the next acquisition. The deal closes. Then your rental income starts servicing that debt on both properties simultaneously. Your HELOC rate, say, is 8.5% versus a bridge loan that could be 10 to 12%. So the HELOC is doing the work your savings account can't. So let's look at how it's used on renovation to increase rents and value. So if a property is worth, for example, here, 350 grand, you've got 180 grand equity. You go and pull 40 grand via HELOC, update the kitchen and bathrooms. Your rents go from 1,800 to 2,300 a month, which is a 500 a month increase in rental income. Now the property's appraising at 420 grand. So you got 70 grand in appreciation within 6 months. Just a bonus point here too, interest on HELOC funds used for rental improvements is tax deductible on Schedule E. Check with your tax advisor. This isn't tax advice. So use case 3, bridge financing between deals. Off-market deal closing in 45 days, your next refinancing payout lands in 90 days. So you can draw, say, 60K as bridge capital from your HELOC, close the deal, complete the purchase within 45 days, refinance in 90 days, repay the HELOC. The HELOC bridge cost, 90 days of interest on 60 grand. Sometimes they do interest-only repayments on your utilized amount. At 8.5% would be 1.2 grand. Whereas a hard money bridge loan, same scenario via hard money, would be 4 to 8 grand in fees and interest. Because you've got to remember, every time you take a bridge loan, as opposed to utilizing a revolving credit line, you're paying closing fees on that as well. Let's look at the BRRRR shortfall. You executed a buy rehab rent. The refinance appraisal came in lower than expected, and you're short 30K on the cash out. So let's say the HELOC covers the shortfall, 30 grand drawn to bridge the gap. The deal closes clean, so no deal lost, no investor bought in, no equity given up. The next refinance funds, HELOC repaid, line resets, ready for the next opportunity. So the HELOC is your buffer when the numbers don't land perfectly. And as we know, you always have timelines blowing out with contractors. So this is a great use case for the HELOC. A lot of smart investors will keep a HELOC open on at least one property, specifically for this backup use case. So zero cost until drawn. You pay nothing until you draw. The line sits open, costing zero, ready when you need it. This covers the unexpected. So roof replacements, unexpected vacancy, emergency repair, all covered without disrupting operating reserves. Then you've got your reserves still there ready for deals. So operating capital remains intact and available for acquisitions and opportunities. The HELOC you never draw is still one of the most valuable assets in your portfolio. Here's what you now know that most investors don't. So fewer than 30% of major lenders offer this product. You need to seek out community banks, credit unions, and specialist lenders, not your existing mortgage provider, but check with them anyway. Number 2 is a 720 plus credit score ideally, and a 75 to 80% CLTV are the hard filters. So meet these before applying. Reserves, DTI, and documentation matter equally. Run a title search first, always. So $100 to $120 spent on a title search prevents the number one cause of denial, hidden liens you didn't know exist. And finally, the HELOC is your most flexible capital tool right now. Rates near 3-year lows, your existing mortgage rate stays intact, and equity gets unlocked. As the equity in that property grows over time with values increasing, you can actually increase your HELOC over time as well on that property, dependent on that CLTV. Most investors have no idea how much capital is sitting idle in their existing portfolio, and an investment property HELOC is one of the lowest cost, most flexible capital tools available right now, if you know where to find it and how to structure it. So in the link below, gapfunded.com/book, you can book a free strategy call. We'll walk you through your numbers, show you exactly what's possible with your current equity position. Worst case, you walk away with a game plan and steps moving forward to get prepared. No obligation, no pressure, just some clarity on your options right now. And obviously, if we are going to pull up pre-approvals, they're going to be soft pulls anyway. I'm Mick Wadley, founder of Gap Funded. Let's go close something.